Hi, I'm Kyle Green from Mortgage Alliance. I'm here to talk to you today about one of the new CMHC rules that came into effect on April 19th, 2010 in Canada. This rule that came into effect that I'm going to be talking about today is regarding rental property purchases. CMHC had changed the guidelines from 95% financing down to 80% financing for any rental purchases made in Canada. This rule was mainly implemented because of the overheated markets in both Vancouver and in Toronto during the early spring market of 2010. The Bank of Canada felt that many clients were overextending themselves and purchasing properties that they couldn't afford and didn't have any equity in either. A lot of lenders were starting to become a little wary of this, and I know that myself, I'd done a couple of deals for clients where they were purchasing a number of properties with only 5% down, and CMHC and the lender would be willing to do it, although they'd usually kick back a couple of requests and they'd really press and hold a magnifying glass to the rest of the file. What we found is that with this financing, a lot number of people are looking for other avenues of qualifying, so they're now finding other ways of building up more cash, also finding joint venture partners, which is a really interesting method of doing this as well. It's unfortunate because a lot of clients that I deal with are still purchasing properties that cash flow very well with 5% down, and that really is one of the keys that the lenders are looking for. That goes to one of the other rules that I'll be getting into in another segment of this discussion. But one of the things that we're really looking for now is to see that clients have a larger asset base, and the lenders and CMHC in particular want to see that clients are putting a little more of their own skin in the game when they're purchasing these rentals. The reason that they're really worried about this with 5% down is that with 5% down, the insurance premium is actually 6.9%, and that's added on to your mortgage amount. So you're actually financing over the value of the property right away. So if values dropped instead of increased over a short period of time, then you'd be looking at a situation where you actually have negative equity. And if you were to default on that property in that given time, the bank and therefore CMHC are going to lose a lot of money. So that's something that they really want to avoid, and this is why they've changed this rule.